Learning Objective 1 is to understand why organizations budget and the processes they use to create budgets. A budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. The act of preparing a budget is called budgeting. The use of budgets to control an organization's activities is known as budgetary control. Planning involves developing objectives and preparing various budgets to achieve those objectives. Control involves the steps taken by management to increase the likelihood that the objectives set down at the planning stage are attained and that all parts of the organization are working together toward that goal. Budgets communicate management's plans throughout the organization and define goals and objectives that can serve as benchmarks for evaluating subsequent performance. The budgeting process forces managers to think about and plan for the future. It provides a means of allocating resources and can uncover potential bottlenecks before they occur. Budgets coordinate activities of the entire organization by integrating the plans of its various parts. Managers should be held responsible for those items, and only for those items, that they can actually control to a significant extent. Responsibility accounting enables organizations to react quickly to deviations from their plans and to learn from feedback. Operating budgets ordinarily cover a one-year period corresponding to a company's fiscal year. Many companies divide their annual budget into 4 quarters. A continuous or perpetual budget is a 12-month budget that rolls forward 1 month or quarter as the current month or quarter is completed. A self-imposed budget or participative budget is a budget that is prepared with the full cooperation and participation of managers at all levels. Advantages of self-imposed budgets are: 1. Individuals at all levels of the organization are viewed as members of the team whose judgments are valued by top management. 2. Budget estimates prepared by frontline managers are often more accurate than estimates prepared by top managers. 3. Motivation is generally higher when individuals participate in setting their own goals than when the goals are imposed from above. 4. A manager who is not able to meet a budget imposed from above can claim that it was unrealistic. Self-imposed budgets eliminate this excuse. Self-imposed budgets should be reviewed by higher levels of management to prevent budgetary slack. Most companies issue broad guidelines in terms of overall target profits or sales. Lower-level managers are directed to prepare budgets that meet those targets. The success of a budget program depends upon 3 important factors. 1. Top management must be enthusiastic and committed to the budget process. 2. Top management must not use the budget to pressure employees or blame them when something goes wrong. 3. Highly achievable budget targets are usually preferred when managers are rewarded based on meeting budget targets. The master budget consists of a number of separate but interdependent budgets. The sales budget is the starting point. All other parts of the master budget are dependent on the sales budget. The production budget is prepared after the sales budget. It in turn directly influences the direct materials, direct labor, and manufacturing overhead budgets, which in turn enable the preparation of the ending inventory budget. These budgets are then combined with data from the sales budget and the selling and administrative expense budget to determine the cash budget. The last step of the process is to prepare a budgeted income statement and a budgeted balance sheet. To help you see the big picture, keep in mind that the 10 schedules in the master budget are designed to answer the 10 questions shown on the next 2 screens. When seeing the big picture, management will ask some of the following questions. 1. How much sales revenue will we earn? 2. How much cash will we collect from customers? 3. How much raw material will we need to purchase? 4. How much manufacturing costs will we incur? 5. How much cash will we pay to our suppliers and our direct laborers, and how much cash will we pay for manufacturing overhead resources? 6. What is the total cost that will be transferred from finished goods inventory to cost of goods sold? 7. How much selling and administrative expense will we incur, and how much cash will we pay related to those expenses? 8. How much money will we borrow from or repay to lenders, including interest? 9. How much operating income will we earn? 10. What will our balance sheet look like at the end of the budget period? A master budget is based on various estimates and assumptions. For example, the sales budget requires 3 estimates assumptions as follows. 1. What are the budgeted unit sales? 2. What is the budgeted selling price per unit? 3. What percentage of accounts receivable will be collected in the current and subsequent periods? When Microsoft Excel is used to create a master budget, these types of assumptions can be depicted in a Budget Assumptions tab, thereby enabling Excel-based budget to answer what-if questions. Learning Objective 2 is to prepare a sales budget, including a schedule of expected cash collections. 1. The marketing department of Royal Company is preparing budgets for the quarter ending June 30th. 2. Budgeted sales for the next 5 months are April 20,000 units, May 50,000 units, June 30,000 units, July 25,000 units, August 15,000 units. 3. The selling price is $10 per unit. The individual months of April, May, and June are summed to obtain the total budgeted sales in units and dollars for the quarter ended June 30th. Royal forecasts total unit sales of 100,000 and total sales revenue of $1 million. All sales are on account. Royal collects 70% in the month of sale and 30% in the month following the sale. The March 31st accounts receivable balance of $30,000 will be collected in full in April. The first step in calculating Royal's cash collections is to insert the March 31st beginning accounts receivable of $30,000 into the April column of the cash collection schedule. The second step is to calculate the April credit sales that will be collected during each month of the quarter. April collections will be $200,000 times 70%, or $140,000. The remaining 30%, or $60,000 of April's projected sales will be collected in May. The third step is to calculate the May credit sales that will be collected during each month of the quarter. In the month of May, $500,000 times 70%, or $350,000, will be collected. The remaining 30%, or $150,000, of May's projected sales will be collected in June. The final step is to calculate the June credit sales that will be collected during the month of June. In the month of June, $300,000 times 70%, or $210,000 of June sales will be collected. The remaining 30%, or $90,000 of June sales, will be the June 30 accounts receivable balance, as that amount will be collected in July. The final step is to calculate the total for each column in the schedule and the total for the quarter of $940,000. What will be the total cash collections for the quarter? $940,000 is the total cash collections for the quarter. Learning Objective 3 is to prepare a production budget. The production budget must be adequate to meet budgeted sales and to provide for the desired ending inventory. The management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. Let's prepare the production budget. If Royal was a merchandising company, it would prepare a merchandise purchases budget instead of a production budget. The first step in preparing the production budget is to insert the budgeted sales in units from the sales budget. Required production in units for April is equal to the budgeted sales of 20,000 plus the desired ending inventory minus the beginning inventory. Ending inventory is equal to 10,000 units, or 20% of budgeted May sales, and beginning inventory is equal to the March 31 ending inventory. What is the required production for May? The correct answer is 46,000 units. Required production for May is equal to budgeted sales of 50,000 plus desired ending inventory of 6,000 units minus the 10,000 units in beginning inventory for a total of 46,000 units. Notice that April's desired ending inventory becomes May's beginning inventory. The required production for June of 29,000 units includes a desired ending inventory of 5,000 units. This is 20% of July's projected sales. April's beginning inventory and June's ending inventory are carried over to the quarter column because April is the beginning month and June is the ending month in the quarter. For the quarter, 101,000 units will need to be produced to meet the budgeted sales and inventory goals. Learning Objective 4 is to prepare a direct materials budget, including a schedule of expected cash disbursements for purchases of materials. At Royal Company, 5 pounds of material are required per unit of product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. On March 31, 13,000 pounds of material are on hand. Material cost is 40 cents per pound. Let's prepare the direct materials budget. The first step in preparing the direct materials budget is to insert the required production in units from the production budget. The second step is to calculate the monthly and quarterly production needs in terms of pounds of direct material. The third step is to calculate the materials to be purchased in April. April's desired ending inventory is equal to 10% of May's production needs, or 23,000 pounds, for a total of 153,000 pounds needed in April. The beginning inventory from March 31 of 13,000 pounds is subtracted from total needed to calculate a total of 140,000 pounds of material to be purchased. Now, why don't you calculate the materials to be purchased in May? Refer back to the previous slide. How much materials should be purchased in May? The correct answer is 221,500 pounds. To calculate the materials to be purchased in May, notice April's desired ending inventory becomes May's beginning inventory. May's desired ending inventory is 10% of June's production needs of 145,000 pounds. Total pounds needed for production equals 230,000. Adding the desired ending inventory of 14,500 and subtracting the beginning inventory of 23,000 means that a total of 221,500 pounds of material must be purchased in May. The materials to be purchased in June are calculated in the same way as May. Ending inventory for June is based on July's expected production. Notice that the totals for the quarter including ending inventory for June, the last month of the quarter, and beginning inventory from April, the first month of the quarter. Royal pays 40 cents per pound for its materials. 1/2 of a month's purchases is paid for in the month of purchase, and the other half is paid in the following month. The March 31 accounts payable balance is $12,000. Let's calculate expected cash disbursements. The first step in calculating Royal's cash disbursements is to insert the beginning accounts payable balance of $12,000 into the April column. The second step is to calculate the April purchases that will be paid during each month of the quarter. The total cost for April purchases is $56,000, which is the 140,000 pounds times 40 cents per pound. Based on the payment policy, 50%, or $28,000, will be paid in April, and the other $28,000 will be paid in May. See if you can compute the expected cash disbursements for materials for the quarter. What are the total cash disbursements for the quarter? The correct answer is $185,000. The remaining steps include calculating the May and June purchases that are paid during each month of the quarter and adding up the totals, which come to $185,000. Note that accounts payable at June 30 is equal to $28,400, which is 50% of June's purchases. Learning Objective 5 is to prepare a direct labor budget. At Royal, each unit of product requires 0.05 hours, 3 minutes, of direct labor. The labor can be unskilled because the production process is relatively simple and formal training is not required. Royal pays its workers at the rate of $10 per hour. Let's prepare the direct labor budget. The first step is to enter the units of production for each month from the production budget. The second step is to compute the direct labor hours required to meet the production needs. Each unit of output requires 0.05 direct labor hour. That means the company requires 1,300 direct labor hours in April, 2,300 direct labor hours in May, and 1,450 direct labor hours in June, for a total of 5,050 for the quarter. The next step is to compute the total cost based upon the labor hours required and the $10 per hour wage rate. Royal will pay $13,000 for direct labor in April, $23,000 in May, and $14,500 in June, for a total of $50,500 for the quarter. What would the total direct labor cost for the quarter be if the company pays time and one-half, $15, for all hours worked by employees over $2,000 per month? Is the correct answer $51,700, $52,000, $53,250, or $57,000? Employees worked less than 2,000 hours in April and June and 2,300 hours in May. As a result, there were 4,750 regular hours and 300 overtime hours paid for the quarter. Total direct labor cost equals $52,000. Learning Objective 6 is to prepare a manufacturing overhead budget. Royal applies manufacturing overhead to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. Fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, primarily depreciation of plant assets. Let's prepare the manufacturing overhead budget. Because overhead is applied on the basis of direct labor hours, the first step in preparing the manufacturing overhead budget is to enter the budgeted direct labor hours from the direct labor budget. The variable manufacturing overhead costs for each month and in total is calculated by multiplying the variable manufacturing overhead rate of $20 times the number of direct labor hours used in the month. Variable overhead of $26,000 in April, $46,000 in May, and $29,000 in June is expected to be applied for a total of $101,000 for the quarter. The next step is to add the $50,000 of fixed manufacturing overhead costs to the variable overhead manufacturing costs to calculate the total manufacturing overhead costs for each month and in total. The predetermined overhead rate of $49.70, rounded, per hour is calculated by dividing the total manufacturing overhead for the quarter of $251,000 by the 5,050 total labor hours required during the quarter. The final step is to calculate the cash disbursements for manufacturing overhead by subtracting the non-cash depreciation cost from the total manufacturing overhead costs. The cash overhead amount will be used in the cash budget. Royal can now complete the ending finished goods inventory budget. The first step in preparing this budget is to compute direct materials cost per unit. Each unit requires 5 pounds of direct material at 40 cents per pound, for a total of $2 per unit. The information comes from the direct materials budget. The second step is to compute the direct labor cost per unit. It takes 0.05 hours to produce 1 unit, and the pay rate is $10 per hour, making the direct labor cost 50 cents per unit. The information comes from the direct labor budget. The third step is to compute the manufacturing overhead cost per unit. The predetermined rate of $49.70 per direct labor hour was calculated when the manufacturing overhead budget was prepared. That amount is multiplied by 0.05 hours for an overhead cost per unit of $2.49 and a total unit cost of $4.99. The final step is to calculate the value of the ending finished goods inventory. The total value of $24,950 is based on the ending inventory in units from the production budget times the computed unit product cost of $4.99. The final step is to calculate the value of the ending finished goods inventory. The total value of $24,950 is based on the ending inventory in units from the production budget times the computed unit product cost of $4.99. Learning Objective 7 is to prepare a selling and administrative expense budget. At Royal, the selling and administrative expense budget is divided into variable and fixed components. The variable selling and administrative expenses are 50 cents per unit sold. Fixed selling and administrative expenses are $70,000 per month, which includes $10,000 costs, primarily depreciation, that are not cash outflows of the current month. Let's prepare the company's selling and administrative budget. The first step in preparing this budget is to multiply the variable selling and administrative rate of 50 cents by the 20,000 units budgeted to be sold in April. The second step is to add the $70,000 fixed S&A expenses to arrive at total S&A expenses of $80,000. The third step is to deduct the $10,000 non-cash S&A expenses to arrive at cash disbursements for S&A expenses for April of $70,000. Calculate the selling and administrative cash expenses for the quarter. What are the total cash disbursements for selling and administrative expenses for the quarter? The correct answer is $230,000. The same steps are followed for the months of May and June to arrive at total cash disbursements for S&A expenses for the quarter of $230,000. Learning Objective 8 is to prepare a cash budget. The cash budget is divided into 4 sections. 1. Cash Receipts section lists all cash inflows excluding cash received from financing. 2. Cash Disbursements section consists of all cash payments excluding repayments of principal and interest. 3. Cash Excess or Deficiency section determines if the company will need to borrow money or if it will be able to repay funds previously borrowed. 4. Financing section details the borrowings and repayments projected to take place during the budget period. All of this information is needed to prepare the cash budget, so it would be a good idea to write down this information or print the slide. The first step is to calculate the total cash available. April's beginning cash balance was $40,000. This amount is added to the expected cash collections of $170,000 in April, for a total of $210,000 cash available. The second step is to calculate the total cash disbursements. Cash disbursements for April are $40,000 for raw materials, $15,000 for direct labor, $56,000 for cash manufacturing overhead, and $70,000 for cash selling and administrative expense. Non-cash depreciation costs are excluded. During April, the Board of Directors paid a cash dividend of $49,000 for total disbursements of $228,000. The schedule of expected cash disbursements is $40,000. Manufacturing overhead budget is $56,000, and selling and administrative expense budget is $70,000. The third step is to calculate the excess, deficiency of cash available over disbursements. Because April's cash available of $210,000 is less than total cash disbursements of $228,000, there is a cash deficiency of $18,000. The fourth step is to determine the financing requirements and the ending cash balance. Because Royal maintains a minimum cash balance of $30,000, they must borrow $48,000 on the line of credit. After the financing, the ending cash balance for April is $30,000. This amount becomes the beginning cash balance for May. These 4 steps are repeated for the month of May. The result is a $40,000 excess of cash available over disbursements. Royal could make a payment on the loan because the minimum required cash balance is only $30,000. Management decides to wait until June, when they will have enough excess cash to repay the entire amount. What is the excess, deficiency, of cash available over disbursements for June? The correct answer is $130,500. The same 4 steps are repeated for June. The result is an excess of cash available of $130,500. This slide shows the completed cash budget for the quarter. Total interest expense for the quarter is computed as the borrowings of $48,000 times 16% interest rate times 3 months divided by 12 months, which equals $1,920. With interest expense from the cash budget, Royal can prepare the budgeted income statement. Learning Objective 9 is to prepare a budgeted income statement. The sales revenue comes from the sales budget. The cost of goods sold on a per-unit basis comes from the ending finished goods inventory budget. The selling and administrative expenses come from the S&A budget. The interest expense comes from the cash budget. Based on these budgeted amounts, net income for the quarter is $239,080. The numbers for the budgeted income statement come from budgets that have already been prepared. The sales revenue comes from the sales budget. The cost of goods sold on a per-unit basis comes from the ending finished goods inventory budget. The selling and administrative expenses come from the S&A budget. The interest expense comes from the cash budget. Based on these budgeted amounts, net income for the quarter is $239,080. Learning Objective 10 is to prepare a budgeted balance sheet. Please make note of this additional information as it is needed to complete the budgeted balance sheet. Budgeted balance sheet for Royal Company. The cash balance of $80,580 comes directly from the cash budget. Accounts receivable of $90,000 is 30% of June's $300,000 sales. Raw materials inventory of $4,600 is calculated by multiplying the ending material inventory of 11,500 pounds by the 40 cents cost per pound. The finished goods inventory of $24,950 is taken from the ending finished goods inventory budget. The land and equipment amounts are given. Accounts payable of $28,400 is 50% of June's $56,800 purchases. The balance in the common stock account is given. The calculation of retained earnings is shown on the next slide. The April 1 balance of retained earnings is given. Adding the net income for the quarter and subtracting the dividends paid in April calculates an ending retained earnings balance of $438,730. Ending balance of retained earnings of $438,750 is computed as the beginning balance of $248,650 plus net income of $239,080 minus dividends of $49,000. End of Chapter 8.